Welcome to the Build and Exit podcast. I'm Julie Wilkinson. I started the podcast off the back of the work I do in my company, Wilkinson Accounting Solutions, because I found there was a big gap in the SME market, across the world, but particularly in the UK, for SMEs who are looking to successfully acquire or exit their company. I'm really excited today to have Gavin Page. Hi, Gavin.
Hello.
Hi. Gavin is a serial entrepreneur, 28 years experience, 10 years sort of in buy and build, and he's going to talk a bit about that today. Had a group of 9 companies turning over, north of 8 million. And we're going to sort of go into that journey, but also I'm not going to spoil it too much because we're going to talk about it, but how his group got impacted when one of those businesses failed ultimately. So I just want to say thanks for coming on, Gavin, and hand over to you to tell a bit about yourself and why you're wanting to come on the podcast.
Yeah. Hi, everybody. Gavin Page, as Julie said, 28 years now in business, and you just don't realise how much experience you've got really until you sit back and think about it. But yeah, my journey started as an employee in corporate world for Kodak, selling a printing product, proofing system across the world for them. And I was 24 and I got to the age of just 29, 30. Couldn't do any more with Kodak, couldn't go any higher. I'm very black and white and direct, if some people say. And I thought, you know what, I could do this myself. And so I left the corporate world, left my pension. And the next day I got out of bed, I wasn't employed and I didn't have an income, which is a scary thought in itself, but it seemed scary, but it didn't faze me at the time. Maybe that was just through naivety. But I white labeled a product and went out there and sold this product, against Kodak, if you like, across the UK into printing manufacturing companies. And yeah, it was successful. And we got to around 2012. And all that time I'd been in the print industry. And I decided to, try and grow a bit faster and harder and set up the group that I did. And we did our first acquisition in 2016. I was struggling to get over £1 million in turnover and working all hours, organic growth, doing all the marketing that you would do. But it was just proving too difficult to nudge it up over that 1 million. And that was my magic number at the time. That was my goal. So then somebody said, have you thought about acquiring companies through acquisition? And obviously I didn't know much about that. I thought you needed lots of money. You needed degrees in how to do these kinds of things. But I got mentored by a friend and showed me the ropes, the basic ropes. And eventually we did our first acquisition in 2016, which was a print management company. And it was 1.2 million turnover, very profitable. The owner, unfortunately, died from cancer. And it was passed to his daughter to look after. She wasn't interested, so she put it up for sale. And they got an accountant to sell it for them. But the guy I was dealing with, remember this was my first deal, if you like. I had my financial director with me as well, guiding me. And the guy they got involved was just a young lad in the accountancy. He didn't look like or seem like he'd done any M&A before, and we knew more than him. And I think that was a big part of buying this business. We actually knew more about the process than what they did. And eventually we bought that business December the 13th, I think it was. So it was a nice Christmas present. 2016, and they left all their money in the bank account. We had 2 bank accounts, a current account and a savings account, and left in the region over 200,000 in there. So, I mean, that which you just wouldn't do, really, would you, Julie? If you've been advised right.
No, probably not. Or you wouldn't. Yeah.
Yeah. So that started us on the journey. You know, it was and I liked it. You know, I thought, you know what, I'm good at structuring deals. I can do this. Let's continue. And immediately overnight, we'd put an extra 1.2 million on the company, and another 250,000 on the bottom line. So, you know, very nice. Let's continue this journey. And that's the way I started in the acquisition journey.
Yeah.
And obviously, you know, you make mistakes along the way. You get as much help as possible from your peers, people who you respect. Yeah, so there was a lot of hand holding for me with people, which was great. And we went on to do 9 acquisitions over the next several years. Unfortunately, one of those acquisitions was a print-on-demand company in just after COVID, 2021, and it was doing around 1.4 million. And it's something like if you had a birthday and you wanted "Happy Birthday, Julie" on your socks, we'd print them and send them out. But the key thing, your birthday, they have to get there on your birthday day or before. And I think there was some Royal Mail strikes on the last quarter of that year, and we were doing around 1,500 orders a day. And you can imagine if somebody's ordering things, let's say from Halloween day, night, right the way through to Christmas day, and your goods aren't dropping on the day they're supposed to because Royal Mail are on strike or they're not delivering, it caused absolute carnage. And it was a print on demand. It was via Amazon. So it was all e-commerce. And obviously any refunds were come back from the client to Amazon, and then Amazon would take the money back off us. So in our busiest period, where we'd probably do 300,000-400,000 over those 3 months, we didn't do anything because most of the jobs didn't get delivered on time, so they were clawed back by Amazon, and that left a big hole in the company. And it was it was tough. But what I didn't mention before that, the way we bought that company, it was in distress, and we actually bought it for £1. And you often hear, "Don't buy a distressed company unless you know what to do with it and you know how to fix it." Well, I thought I knew how to fix it. You know, it was my 6th company that we'd bought, and yeah, it was and we couldn't buy it as an asset purchase, which you normally would do if it's distressed, and just take the good parts of it, because Amazon wouldn't allow that. When you're buying an and it's set up with Amazon, you know, you've got to have the trading name continuity, and you've got to have the same bank account. So we had to do a share purchase, and we bought it for. What we did though, we made sure, you know, any debts that were in the company, which were PG'd with the previous owner, stayed with the previous owner, and that saved us a little bit as we were getting the company back to profitability. You know, it was sapping a lot of money from the group, and I think we put around 200,000 of the group's money to try and get that company into a positive state. And we were all on track. We were about 6 months away from doing that, and then the Royal Mail strikes happened, and that really put a lot of pressure on that company. And the directors of the group were not prepared to put any more money into it to keep it trading. So we decided, or the director decided, to cease trading. And that had a massive knock-on effect, which it doesn't matter how well you've structured your companies through SPVs. If your name is above that door as a director, especially in the print industry and manufacturing, any credit agencies see your name, and then obviously you're attached to all these other companies. They start looking at them closely and reducing your credit rating down on those as well. So what was happening? It was causing it was like a pack of cards folding, one by one. So each company's credit rating kept going down and down. And as a group, we had a 750,000 credit rating. And eventually it went down to around 80,000. Now, for an 8 million turnover group, that's not sufficient if you paper. And, you can't trade pro forma in those situations. So that was a big headache. And, and it just had a massive effect across the group to trade. And this all coming time as well. The following year, it was the Ukraine war. So we had one factory, 50,000 square foot factory. We've done our due diligence. We know what the electricity bills are, the gas bills over the years. We know when the contracts are coming up for end and renewal. This is all part of the due diligence process. And this one factory, their monthly electricity bill was 2,500 a month. That was it. And that was running 140 machines. But as soon as we came out of contract at the same time, Russia decided to invade Ukraine. So, and obviously all the energy costs skyrocketed. And we came out of contract, and that one company's energy bill went from 2,500 a month to £12,500 a month. And there's nothing we could do about it. And that was the most profitable company in the group. It was making net $500,000, but it still had a massive impact as well. And losing the credit rating because of the £1 deal, and losing, and the energy bill put us in a distressed situation. And the directors then looked to do, I wouldn't say a fire sale on the best parts of the business, but it wasn't a planned exit. And so the directors managed to sell 3 of the most profitable parts of the group, which was great, and they're still running to this day under different ownership or part of a bigger group. And the rest, unfortunately, had to go into administration. 3 years later, we're nearly out of it. It's they're nearly all. I think next week they will be completely finalised across the group.
And how did that? So when you went through this distress situation, and they obviously made the decision to close. I mean, how did that impact you personally? How did you feel?
Yeah, well, massively. It's something you work for all your life. And then I remember, whatever one thing to say, we didn't have any. We had one PG. I had one PG, and that was going back from 2018. And in the print industry, you can't buy machinery unless you put a PG against it, and it's as simple as that. It's so you either buy the machine or you don't. I was named because it was a joint PG, so so that that was hard, and there was 1 year left of the interest to pay on that, but so I had that to contend with. So you can't get rid of that, and I had to look at other routes. So I remember being in my office here thinking, well, what do I do now? I'm one of these who's out the door at 6 o'clock, back in at 7 o'clock, and I didn't have a purpose anymore. So, and I'm good at deal origination, finding the deals, putting people together, finding companies to do the deals, structuring deals. It's what I love doing, and that's why I get out of bed. The fact that I didn't have a job doesn't worry me because, if you like, I've always been commission only all my life since the age of 30. Unless I get out of bed and work, I don't earn money. So that, it's never entered my head to go and get a job, a proper job. It's just not me. And I thought, what have I learned over the last 10, last 7 years at a time? And I thought, well, I could have grown the group twice as big, twice as fast if, when I spoke to business owners, and it comes back to valuations of business, that they're up for sale, but the valuations were way off the mark. So, certain brokers out there have gone in and given them a fairy dust value. These are people in the 60s and 70s who want to retire, might have ill health, but they're still dreaming of that £1 million valuation in their head. And if somebody's got a figure in their head, it's very hard to move them off that figure downwards. And that was a challenge. So I thought, that's not right. I also thought, 28 years in business, I know a lot of things, and I need to pass some of these things on. I've learnt a lot in the acquisition journey of buying and selling businesses. I need to help other people not make the same mistakes that I did along the way. And when you start thinking about it and writing things down, I have got a lot to somebody. And so I decided to set up my own boutique brokerage, if you like, coach to sell and coach to buy. So mentoring other people. I do like the buy side more than the sell side. That's what I love. And this year we've actually just set up the listing side, the selling side now for the brokerage. And that's where I am in my journey. So 3 years after it happened, we're headwind at last.
Wow. So when you go back to because you say about helping buyers not make the same mistakes you made, what do you think were the mistakes that you made in the acquisition journey? Was there any big ones or?
Yeah, first thing, over leverage. So, 90% over leverage, on the machinery assets, I won't do more than 60 now. I make sure there's some skin there for, for anything. Try not to do PGs. I know it's very difficult. Depends which sector you're in. If it's CapEx heavy, like the print and manufacturing engineering, sometimes there's no way around not having a PG. But you try and limit it as much as possible. Same as invoice financing, for example. I do think that's the best way of raising the capital with the least risk, because the PG is probably only going to be maximum 50%. And unless you've done any falsifying invoicing, then if anything happened to the company, you usually collect, you will collect all your debtor book in, apart from probably 10%, 15%, but there's plenty of headroom. So, I do advise that is, again, it's, if you don't have to do it, don't do it, because it is pretty messy initially, so you get used to it. Don't be ego driven like I was in the end, doing X amount of deals in X amount of time. If it had bought the last company that we bought, if that had been the first company we bought as a group, then we probably wouldn't have bought many others after that, because that was the the big one, the nice one, the pension fund one, and unfortunately, we didn't get to reap the rewards of that company. It was part of the collapse. So yeah, trust your gut. the £1 one, my gut said no, and I didn't trust it. My ego said yes. Yeah, and again, big mistake. Looking back, but I'm big enough, broad enough shoulders to admit it, and and as long as you don't make the same mistake twice, that's it.
It happens to the best of them. I mean, my experience, over leveraging is a big, like you look at big players, like big corporates that are folded, like something like Woolworths. I can't remember, they had X hundred, I can't remember the number, but they had a massive debt, maybe like 30 billion or something like that debt. I can't remember the exact number. And they basically, what had happened was they were over forecasting, and they hadn't kept accurate working capital. So they didn't have good hand on sort of like work in progress and stock. So then when the market changed, I know a contractor that went in and sort of helped Woolworths close to the period of the time before it failed. And they ended up finding out that their accounting was completely all over the place, which is actually quite common for corporates. I've worked in quite a lot of corporates, and it's quite common for it's not only in small SMEs that struggle. And anyway, after that, they uncovered basically, massive hundreds of thousands, if not millions of sort of undeclared stock and, working capital discrepancies from the assets. And ultimately they were over leveraged, had poor financial infrastructure. So then when the market changed and the sales dropped, they couldn't, they obviously couldn't just fund the debt anymore. And ultimately that led to the collapse. So I think over leveraging. So my biggest things that I see from businesses, both in corporate and in SME world, it's similar problems, just on a bigger scale in a corporate than it is in a smaller business. But they end up having the same problems. As I see, it's poor financial integrity. We see hundreds and hundreds and thousands, if not millions of pounds of integrity issues, like with stock and invoice financing. You mentioned invoice financing. Invoice financing is actually a big one. I remember we went into somewhere after they'd been acquired. And because what we tend to find is a lot of people do DD on financial statements because that's what they get, because nobody has any management accounts, do they? Let's be honest, no one has management accounts, do they? Or I've never met one seller that's got a proper management accounts, as you would know it. But there isn't often much due diligence on integrity between systems. So you can have a balance sheet that can tell you your invoice factoring liability is X, but actually, when you go on to the invoice factoring finance and their liability that you owe there is £750,000 more than your liability on your balance sheet, which is what you've built the valuation of, you've suddenly got a big cash flow risk. Now, it may not be an immediate cash flow risk because perhaps it's not going to impact the drawdown you do tomorrow, but it does impact the overall working
90
capital.
days.
It does impact the overall net asset position, because what it ultimately means is if you've got the wrong liabilities and the wrong assets, that's been driven by potentially years of accumulated incorrect profits, because that's how it builds up. It builds up through incorrect transactions in the P&L, build up an incorrect balance sheet, and therefore effectively when your liabilities are more than you expect, the reality is it's likely that your profits are overstated.
Yeah, absolutely.
Well, they will be overstated.
Absolutely.
Historically.
And it just shows that it doesn't matter how much due diligence you do, you can't account for what happens out there in the big wide world, the market. There's always going to be a skeleton in the cupboard, always. All sellers are liars, as I say. But you've got to try. And, I would say to anybody out there, you've got to try. And if you want to be entrepreneurial, you have got to take a risk. You can't be so risk aware that you don't want to do it, because you won't end up buying a company.
No.
There's got to be some element of risk, hence why I'm not an accountant, because, I do take risks, and they work, and sometimes they work, sometimes they don't. And, when they don't work, it can be pretty horrific.
Yeah, but I think, I take risks. When I did my acquisition, I got a PG on my cash flow funding.
Well, the fact you said that is fantastic, because people need to hear that.
Yeah,
Julie.
I got a PG on my cash flow funding but what I saw was what I looked at, my own personal situation, what's the biggest risk I can take personally. So, it's not necessarily you can't ever have a PG, but don't over leverage the PG because you've got the same risk personally as you have in the business. Obviously, it's higher risk personally because there's more to lose, I suppose, in a shorter period of time. But I got a PG on my loan and I took the risk because I actually had close to a time that I did the acquisition. We were working with, had quite a big contract with a company that actually sort of a lot of it went insolvent close to when we were doing the acquisition. And that hit a lot of our cash flow at the same time I did the acquisition. But I still did the acquisition.
Yeah.
Because I built the cash flow out and I thought,
I don't think there's many entrepreneurial accountants like you, Julie. That's the thing. There's, if you overall, you're probably probably top 5% who are like that in your industry. Would you not agree with that? I don't.
Yeah, I would agree with it. Yeah.
Yeah, I mean, there's another point as well is that I had some. It's about your management team as well, and nobody's ever going to be as good as you because you're the one who started the business and runs. Been running it for whatever. But if you find somebody who you think are excellent and they are excellent and they can do the job, you have to pay them, and you have to get your big boy pants on, as somebody told me, and make it happen. And having somebody beside you or, a team around you that are better than you, that's the way you'll succeed as well. And I had too many mediocre managers in the business and not enough leaders, but it's very hard. You give them what you've got, and it's very hard to find good people in any sector at the minute.
Yeah, no, I know. But
I mean, out of all those companies, I had probably three people or that who share the same vision and philosophy, and they're on par with what we were doing. So again, management, having a good team around you, structured around you. And my financial director, he might be looking, he might not, but he wasn't strong enough. I've got a strong personality, and I think I bullied him a little bit to say yes. And I think what I needed was somebody to say no.
Mm-hmm.
Somebody stronger.
Yeah.
And because we do what we do. We're entrepreneurial because we don't like to be told what to do. Yeah. And but sometimes you need to be told, and I think that was that's another factor.
Yeah, I see it. And I think, it's all down to risk versus reward at the end of the day. What I find interesting is you have, my opinion is, for CEOs, shareholders, directors, whatever you want to call them, the biggest risk is bankruptcy and jail, ultimately. Yeah. They are the two biggest risks to any business owner.
Yeah.
And in business, maybe not in life, but in business. And what I find interesting is are people mitigating their biggest risk? So you will find people that are micromanaging every process. They won't let someone make payments for them because they might do it wrong.
Yeah.
But they don't have controls over the biggest risks that could literally ruin their life. So I remember, I say this story quite a bit. I saw someone that it was like an antique business. And after they acquired it, they found out something like 75% of the customers paid in cash for high value items, and they didn't have any money laundering processes. And money laundering for that size business, I've seen people go to jail for bribery and money laundering and health and safety. I think bribery and money laundering are the two biggest hidden risks that people don't think about, because a lot of people know about health and safety because health and safety has been around for a long time, but bribery. So anyway, now imagine you've bought something and you've got 75% of your customers paying cash, and now you've got this sort of ethical and legal moral because you go in, your team are going, no, if these people don't want to be money laundered, they just won't buy from you anymore. But you don't do it, you get investigated, you go to jail.
Yeah.
You do it and you potentially lose your customers. But, obviously they acquired into it. And, that's another thing to think about in DD. It's not just necessarily financial. You sort of got, and there's financials and there's legal, but legal touches sometimes off. Legal focuses a lot on the warranties and the provisions and that sort of thing.
Yes.
But the legals in terms of compliance and negligence, basically, sometimes they're very hidden. They're hidden risks in there. But what's interesting is, so obviously it passes over, the risk passes over to the buyer because they now become the new legal owners. However, for people to be running these businesses for years, and doing this, they're ultimately putting themselves at risk. So to me, it's risk versus reward, because it's like, if you're in an industry, find out your biggest legal risks, and then put the things in place to mitigate those risks. But people are so busy doing the doings that they don't think about, the top level issues.
That's right. Yeah. But so, I've had a colourful career, if you like.
Yeah, definitely.
So I'm good at buying and selling businesses, but don't ask me to run one.
No. And I'm just interested to know, when this bank, when you said this insolvency happened and it impacted the directors personally, because I presume you were a director of this group.
Yeah.
So not that you have to go into numbers or anything, but how long did it impact you personally for? Did it impact like personal credit ratings, or was it just related to business?
Yeah, it's just the business that was.
Business,
So
no doubt.
So there's no bankruptcy.
No.
Thankfully, and So, but over the years, if you surround yourself with the right people, you learn all those things. You learn to put things in place, to, like I say, mitigate the risks. So if something did happen or could happen, potentially happen, you've got things in place to block it or save you. And over the years, that's what we did. There's a lot that I don't know still, but there's a lot that I do know, and that's why I do what I do, because I love doing what I do, and I love helping people. I love holding somebody's hand and walking them through the process from start to finish. And to see them, the smile on the face when they're signing the completion docs. Yeah, there's no better feeling, because I've been there, so I know what it feels like. I know what they're feeling at that moment in time, and I've done my job then. That's great.
So if anybody wants to reach out to you to look at sort of buying or selling their business, what do you look for? What's your criteria?
Yeah, so my criteria, I won't touch retail, franchises, or e-commerce. So, but anything else, I'm open for a conversation. I'm in Cheshire, but I travel all over the UK to be with my clients, and so I'm not in one place all the time. I'm everywhere.
Yeah. Well, thanks for coming on, Gavin. It's coming to the end of the podcast, but it's been really good. And I think it's really nice. It's really good to share. Well, not that we like to always talk about the bad side of things, but I think it is useful, because people are often always sharing all the good side of acquisitions and, the bright side of it. And obviously there are dark sides to business and difficulties. So I thank you for coming on and sharing, because obviously, I think it's going to help a lot of people.
Yeah, I think you learn more with the bad things than you do with the good things. Unfortunately, in business, there's potentially more downs and ups, and you've just got to get through them and push through them. And times are tough sometimes, but you've just got to think of the end goal and think of good times and push on. And we're probably the 2% of the population who do what we do, who are entrepreneurs, who are business owners. So you must be doing something just to be in that little percentage.
Absolutely.
So, as a person, and that's what you got to think. Absolutely.
Well, thanks for coming on, Gavin. It's been great to have you. And thanks to all the listeners. If you love the show, hit the subscribe button so more people can find the show. And I look forward to seeing you soon.